You're listening to the Generational Wealth Through Commercial Real Estate podcast. Your host, Will Smith, is a former NFL player that found his passion in commercial real estate. Every week, you will learn from industry experts everything you need to know to get started investing in commercial real estate to build generational wealth.
Ladies and gentlemen, how we doing today? I got Yonah Weiss here with me today. He's the expert in cost segregation. He works with the company Madison SPECS. And man, these guys are saving people millions of dollars every year. Yonah, how you doing today, man? Talk to us, man.
I'm doing wonderful, Willie. I appreciate you having me on the show. It's really a pleasure to finally get a chance to speak face to face.
Oh yeah, man. So what exactly is cost segregation?
It's a really bad word, really, is what. No, I'm just kidding. It's a weird name that the IRS gave to a method of depreciating a property. Basically, a method of taking tax write-offs based on different components of the building.
Yeah. So
simple definition.
Yeah, got you. So like, far as investors, man, because a lot of my audience is invested in multifamily. How can they really use this to their advantage?
So cost segregation is something that needs to get done on a property. It's an engineering study. So even though, it has to do with accounting, right? Depreciation is a tax write-off, an income tax write-off.
Yeah.
It has to do with accounting, but the thing is, accountants can't do it because it requires an engineering component. So the first thing is, the person is going to need to hire a firm that specializes in this, that has engineers that will come to the actual physical property, make a full inspection, and then produce a report that shows how the building depreciates in different components, getting you bigger tax write-offs. And that essentially, as an investor, will translate to you as your portion of depreciation, usually according to your percentage of ownership of the equity of the property. Yeah.
So does that also apply for individuals that's like part of a syndication? And like, let's say somebody, put in $100,000, $200,000 towards the syndication. Do they get that benefit as well?
Absolutely. Most cases, there are obviously occasions where the operating agreement in that particular investment will, will say otherwise. But most cases that I've seen, it's standard that everyone owns shares in the property or shares in the LLC that purchased the property. You own a portion of the equity. And so again, according to that portion of the equity, you'll receive that equal portion of the tax deductions, the depreciation.
Yeah. So why do you think it is that a lot of people are not really taking advantage of something like this? Because I recently just learned about it, but obviously it's been around for a while. What do you think is the cause of that?
I can theorize, but my main goal, and this has been something that I've been doing for the past, close to 2 years with Madison SPECS, is just educating the populace, because that's really, in my opinion, the biggest thing standing in the way is that I don't know about it. It's something tax related, and most people have an aversion to taxes, right? You hear about taxes, you're like, I don't even really want to understand it, right?
Yeah.
It's something my accountant deals with. And that's exactly the problem. Most accountants actually don't deal with this because it is something they can't do. They may, and really good accountants, especially those that are real estate focused accountants, will refer you or partner with or hire a third party firm that specializes in this.
Right.
But most accountants, especially if they're not real estate focused accountants, they may not even know what cost segregation is, because the tax code is so vast. No one can really specialize in everything. So you may have an accountant that, it's a family accountant or it's a business accountant, or they specialize in, corporate structuring and whatever it is.
Yeah.
They may not specialize in real estate and may not know all the nuances and just may not know. So that's what I think is the biggest thing stopping people.
Yeah.
Just learning about it, right? Because once you learn about it, it's like, okay, right? Like this is a no-brainer for most people. Again, there are definitely occasions, and maybe we'll touch on that a little bit. There are certainly occasions where cost segregation, accelerating that depreciation will not be beneficial.
Yeah.
So we can touch on that a little bit too.
Yeah. Most definitely. Definitely want to ask you about that. Now, let me ask you a question on as far as this cost segregation go. Is there a limit, or ask the better way, as far as price value of a property that they should be considering? Like, is it $1 million, $2 million? Like, what do you think?
My general rule of thumb is anything over $1 million purchase price.
Yeah.
Because again, the depreciation is based on the purchase price of that property and not on the actual value. So even if it's extremely undervalued or extremely overvalued, it matters on the purchase price. That's how the IRS determines it. Anything over $1 million is going to be extremely beneficial.
Right.
So it's basically a no-brainer. Under $500,000, it's usually not going to make sense.
Yeah.
It's in that gray area of between $500,000 and $1 million. And again, that's a big gray area. That's a big area, right?
Right.
It's definitely, it could be beneficial based on the individual's tax situation, how much deductions they need, what's their overall situation, and what type of property it is, how big it is, what's unit count. If it's a different type of property besides for multifamily, for example, there are other types of properties that can generate more tax benefits than other type of properties. So it's, regardless, in my opinion, it's worth running the numbers, because that's a service that we provide, is just to run the estimate at no cost. It's just a service. So you can really see up front, hey, is this going to be worth it or not?
Right. So just under normal depreciation, on multifamily, it's what, 28 years, 28 and a half? What's the number there?
27 and a half years for multifamily properties, and any residential properties for that matter. Any commercial building. And the funny thing is, multifamily is not considered commercial for this one thing. So any commercial building depreciates on a 39-year schedule, which means, again, you take that purchase price, you subtract a little bit for land, and then that's your basis that you take a little bit amount every year to write off your taxes.
No, okay, so that's just the building itself. So for the ones that are still trying to figure out what are we talking about here.
I was very vague at the beginning.
So essentially what you're saying, okay, you get the value of the building itself and depreciate that. And then using something like this cost segregation study, you're going to look at every single item in this building that could potentially be depreciated, and you're going to get credit for that towards your taxes, right?
Right. So let me break it down.
Yeah.
Let me break it down a little bit.
Yeah. Go ahead,
just
man.
to make it easy. So cost segregation, again, fancy word, weird name. It means breaking down component depreciation, depreciating the property at different levels. Like Willie said, the property depreciates on 27.5-year schedule.
Yeah.
That means, what does that mean? It means I take the purchase price, let's say $1 million, right? And I divide that by 20, or first I subtract land, because land doesn't, there's a certain value, 10%, 20%, something like that. That does not depreciate. Whatever's left over, I take a small amount every year, a fraction of that every year, 1/27th, and take that as a tax write-off. Tax write-off means I make income, I immediately deduct this amount from that income and only pay tax on the remaining amount. So real estate in general is good because you get this huge, tax deduction called depreciation. But on a $1 million property, that's going to be approximately $30,000, right? If you're talking about a 15-year land allocation, $30,000 is great. But if your income from the property is going to be more than $30,000, you're still going to be paying taxes on it.
Right.
Cost segregation comes along and does this. The IRS allows you to depreciate different components of the property at different rates. So personal property is the biggest category, stuff that includes what we don't even necessarily consider it personal property. The IRS does. They say anything that's not attached or part of the structural component of the building.
Yeah.
Carpeting, right? Appliances, furniture, fixtures, cabinets, countertops, you name it, anything that's not structural. Okay, so excluding, the walls, floors, roof,
Yeah.
windows, doors, okay,
Right.
and their main electric and main plumbing,
Yeah.
that's structural. Okay, those have value and usually is the majority of the value. But for multifamily property, it's usually somewhere between 15 and 25%, right, is going to be allocated to this 5-year property, meaning stuff that depreciates on a 5-year level. Take that example, $1 million property, 20% of it is actually depreciating on a 5-year basis. Simple math, $200,000. Instead of lumping it together and getting a $30,000 deduction every year, I'm going to take an additional, right, $200,000 over the first 5 years, right, which is giving you an extra $40,000 depreciation.
Right.
So instead of your $30,000 deduction, all of a sudden over the first 5 years, you're getting $70,000 deduction.
Right. Right.
Which essentially will help knock off the tax liability, if not to zero, pretty close to it.
Yeah, yeah. So it would make sense then for anyone that's syndicating big deals to get a cost segregation done, because it's going to basically reduce their tax liability to zero.
It's gonna come pretty close, yeah. If not, yes.
Yeah, man. That's cool, man. That's powerful, really. It really is, man. Absolutely. So
it is. It's one of those things that. Go ahead.
No, I was just going to say. So you mentioned something around the bonus depreciation. So explain how that kind of rolls into this.
Bonus depreciation is a law that passed recently in the tax reform, which is an option. Bonus depreciation is really a way to maximize the cost segregation. Okay, so you need to do a cost segregation in order to get or apply or elect really the bonus depreciation. Bonus depreciation allows you to take 100% of that accelerated depreciation. So anything that depreciates on a 5-year schedule, like the personal property we discussed, there's other things that depreciate on a 7-year schedule, a certain type of cable wiring. 15-year schedule is another big one, which is anything that's land improvements. So anything like landscaping or pavement, asphalt, parking lot, okay? Right. All that has a lot of value to it. You can take that value, depreciate on a 15-year schedule. Now with bonus depreciation, you can take that entire amount as a tax write-off in year number 1. Okay, so we're talking about 20%, 25%, sometimes 30% for apartment buildings of that reallocation. Think about this. You buy $1 million property, maybe you put down $250,000 down payment.
Right.
You're now getting in the first year a $250,000 tax write-off.
Wow.
So that's really what the power of bonus depreciation is.
Man, that is crazy. Like it doesn't even seem fair. Like
it does not make sense.
It don't, man. Wow.
It's crazy. It really is crazy. I did a post on LinkedIn this morning. You know me, I'm very big on LinkedIn, right? Yeah. So I did a post this morning and I quoted, there's a famous book, I'm sure you've heard of it, George Orwell's Animal Farm, right? It's a famous book. Everyone had to read it in high school, basically, or whether you read it or not, you had to. Right. So there's a famous quote in that book, right? That it was basically all about communism, right? I'm not going to get into the philosophy, but there's a famous quote that said, like, the animals were like, all animals are created equal, right? But some animals are more equal than others, right? And so that's really the kind of play on communism that it really didn't work out. Like, everyone's equal, but really the people on top are more equal than others. So I did like a post this morning about all taxpayers are created equal, right? But some are more equal than others, because real estate professionals who are getting this bonus depreciation can literally use these tax deductions to offset their entire income, not just income produced from property. So that's really probably the most important rule that can come out of cost segregation or bonus depreciation.
Right. So is that why you see a lot of properties? I mean, obviously there's the loan side of it and the balloon payments coming up on these properties, but is that another reason why you see a lot of these properties trading at that 5 and 7 year mark because they've kind of used all of their bonus depreciation up?
I'm not sure if that's going to be not sure if that's going to be a contributing factor to that. That's interesting. I never really thought about that.
Yeah.
Could
I'm
be.
just, I'm just kind of thinking from the perspective of it's almost like you squeezed all the juice out of it, as far as what you can get as far as savings go on it. And if you keep holding at that point, the only depreciating you're getting is from the building itself, right?
Correct. Yeah. So it's going to be relatively less, but again, it's not everything. Like instead of, right, if you're reallocating even 30%, right, to that first year, you're still getting 70% over 26 years, which means, right, instead of $30,000 every year, you accelerate, you got $300,000 in year number one, right? So in years 2 through 27, you're getting approximately, $22,000 depreciated. So it's relatively less, but it's not as like ridiculous as it may sound.
Right.
The advantage that it does, it really frees up the cash flow for the investors and for the property owners.
Yeah.
That the income that's coming, from the property is tax-free income.
Right.
And it has less to do with the actual property itself because a lot of real estate investors are investing in multiple deals. Yeah. Right. And so they're not looking at just this one property and that's it forever. If a person is just buying one property and that's it forever, then bonus depreciation may actually not be the best solution for them.
Right.
Because it may be better for their tax strategy to kind of balance things out over time.
Yeah. That's why I was kind of looking at it from that perspective for somebody that's going to buy and hold for the long run. In that scenario, it may not make the most sense, but for people that's trying to get in and out on these different deals, then it makes a whole lot of sense and that's the majority of investors out there. There's not a lot of guys that are trying to buy and hold right now. A lot of guys trying to get in, add the value, refi out or sell it and go to the next one.
Exactly. 5 years, they're out, they're on renewal.
Yeah. Good deal,
absolutely.
Man. So how does that play into effect or in fact when you look at something that's like kind of mixed development, like it's retail on the bottom maybe and you got residential units above? Is that still on the 28 or 27 and a half or what is that on?
So there's an interesting rule when it comes to a mixed use property because like I mentioned, you have the 27 and a half year for residential and 39 years for commercial. So what happens when it's a mix of the two?
Right.
So there's an interesting rule the IRS came out that's called the 80-20 rule. And it's kind of weird because it has to do not with the square footage, but actually with the revenue from the property. So if 80% of the revenue is generated by the apartments, then it's the whole building is on a 27 and a half year schedule. But if any less than 80% is produced by the apartments, then it all goes on the 39 year schedule. So that's a very interesting, good question.
That is. I never knew that, man. That's very interesting. Because you're starting to see a lot of that in my community. I'm over here in Greenville, North Carolina. You start to see a lot of student housing go up, and there's retail on the bottom. And I imagine it's very common in the big cities to have retail on the bottom, and 100%. Residential above it. Man. So what are some other things around cost segregation that people need to be thinking about?
You need to be thinking about, are you taking advantage of all your tax strategies? Number one, you need to be thinking about, I think a lot of people think about, well, what's going to be if I'm taking all this depreciation up front? What happens when I sell a property? Is there any downside to taking all this depreciation up front?
Right.
So I think that's, it's a valid point, it's a valid discussion. And the main issue that comes up is something called depreciation recapture tax, right? Which is probably the worst kind of tax that's out there. And a lot of people don't talk about this, especially like the gurus out there, like trying to sell you, like invest in real estate. You're gonna make and pay me $50,000 first, right? So that you can invest in real estate. They're not going to tell you about all the downsides, but depreciation recapture tax is not really so bad all the time because there are strategies around it. Depreciation recapture tax means when you sell a property, besides for capital gains tax, which means if you made a profit on that sale, you have to now pay a tax called capital gains tax on the amount of profit, the amount of gain that you made. There's something called depreciation recapture tax, which means you have to pay a tax on the amount of depreciation that you took.
Yeah.
Which means the IRS is giving you tax deductions the whole while that you're owning the property.
Right.
And a lot of them, if you're benefiting from segregation.
Yeah.
But when you sell, comes time to sell, you have to actually pay a tax on that amount. So there's two things that happen. Number one, if you're doing a 1031 exchange, which a lot of people do, not a lot of syndications do because it can become complicated with syndications.
Right.
But that further is a method, a strategy in the tax code that allows you to defer capital gains tax that also defers the depreciation recapture tax along with it.
Yeah.
There's another thing that happens, which is if you sell a property after 5 years of holding it, okay, or even less, according to some, but let's just keep it simple, after 5 years of holding it.
Right.
We just described how the cost segregation is identifying the property that depreciates on a 5-year schedule, okay? So all of that stuff, which is the majority of the upfront depreciation we're taking, from a tax perspective, it's actually now not worth anything after 5 years. Because if you think about it, I've written off the entire value of this 5-year property. And after 5 years, according to the tax code, there is no longer any tax benefit, tax value, excuse me, in that property, in that personal property. So when you sell a property, you can actually allocate value on the sale to zero or very little to all of that personal property that you already identified with the cost segregation study.
Right.
And now on the sale, you no longer pay depreciation recapture tax on that amount because there's nothing left of it to have value.
Right.
So you're not actually, by doing the cost segregation, you're not actually going to be really, shooting yourself in the foot in any way by paying a lot more later on.
Yeah.
And even if you were, let's just say it like that, even if you were, there's still what the cost segregation is more than anything else is what's called the time value of money. Yeah. Which means I'd rather have money today. I'd rather not pay taxes on my own income today and worry about paying tax on it later. Yeah. And that's a very, that value is incomparable because that can create, if reinvested, that money can create compound interest and just the exponential growth of your wealth when you're not, you don't have your silent partner, Uncle Sam.
Oh yeah. Yeah. You're absolutely right, man. I just completed the CCIM 101 and financial analysis. We learned all about all that kind of stuff, man. $1 today is more valuable than $1 tomorrow. Man,
100%.
A lot of goes into that. So man, that's very interesting, man. It really is to kind of think about how you can buy a property and use cost segregation to reduce your tax liability, and especially that bonus depreciation, man. That's powerful. It really is, man.
100%.
Yeah, man. So just want to ask you one more thing, man, around that. So how does this play? Because some people are invested in mobile home parks because it's so hard to find good deals. Are you able to use this in something like mobile home parks?
Absolutely. Yeah, for sure. In fact, mobile home parks can be extremely beneficial. Like I said, any asset class, any type of property whatsoever can benefit from cost segregation, and some more than others. So mobile home parks is actually one of those examples that takes the cake, because oftentimes in mobile home parks, especially when there are no park-owned homes, so you're just buying land basically, and the people own their own homes. Right. So you're renting to them the pads, right? The concrete pads that are under the homes, you're renting that to the owners of those homes. There may be an office, there may be, right, some other facilities, but generally speaking, that's what you're buying. Right. So when you're buying that mobile home park, literally all you're buying is land and land improvements.
Right.
Now, land improvements, like I mentioned, depreciates on a 15-year schedule.
Yep.
15-year schedule is eligible for bonus depreciation, which means you can buy a $1 million mobile home park.
Yep.
And the land improvement portion of it can be anywhere, I've seen, from 50 to 70 or even up to 80% of the value of that depreciation. So that means you may buy $1 million property and get a $500,000 tax write-off or $700,000 tax write-off in year number 1 from that bonus depreciation.
Dang. Crazy. Wow.
Which is like double or triple or even quadruple what an apartment building would produce.
Yeah. That's crazy. Yeah, I thought that is crazy, man. Just sitting here thinking about how you can use this to your advantage. So, we coming to the end of the podcast here, man. But so tell my listeners, man, how can they find you? How can they get in touch with you? Because I know we've piqued a lot of people's interest.
Yeah, I mean, the best place to find me, believe it or not, is LinkedIn. That's where I hang out. I spend a lot of time giving a lot of value, connecting with a lot of people. So you can find me there. Happy to connect there as well. Or you can reach out to me. My email, yweiss@madisonspecs.com. So you can first letter my first name, last name, WISS. And happy, like I said, if anyone has any questions whatsoever, or you want to get a free estimate, an analysis on a property to see if, what I'm even talking about, like what does this look like in terms of numbers on a real asset, happy to do that for you. So feel free to reach out.
All right, man. I appreciate your time today.
The pleasure has been all mine, Willie.
All right, good deal, man. Let's stay in touch.
100%.
All right, later.
Thank you for listening to the Generational Wealth Through Commercial Real Estate podcast, brought to you by Onyx Capital Investments. Onyx Capital Investments works with investors nationwide to invest in income-producing real estate in emerging markets. Connect online at www.onyxcapitalinvestments.com to learn more about what we're doing. If we have added value to your life, please leave us a review.